I'm Deborah Steinthal. I'm a founder and managing director of Scion Advisors, and my cohort here is Keith Myers with Perkins & Company. And we're delighted to be here. It's my first time on stage in Oregon. I spent a lot of time with big and small audiences in California over the years. And I'm really jazzed. I not only on stage, but I bought a piece of property. I moved up here last May. Yay. So, you know, a little bit of Rob's cough medicine would go a long way. It'd be an easy way to overcome my jitters here. So I'm going to kick in, and I'm going to say that our topic, which is about the health of your businesses, it's a safe bet that most business leaders in this room have a lot of issues on the plate. You're dealing with customer relationships, making great wine, building sales channels, and it can be easy for big picture questions to go to the bottom of the list. But it's important to step back on occasion and assess the health of your business. Knowing how great you are at making money or not is the first step in making sure that you're focusing your time and resources where it matters. Failing to recognize shortcomings early can have disastrous consequences. And you know, this is much like your checkup, your annual checkup, or your periodic checkup with your doctor. How many of you have regular checkups? I can't see you, but there's a few up front here. And the question is, how often should you go in for these? And how many of you have gotten back blood tests and not really had a frame of reference for the results you've gotten? Well, this is much like the topic here this morning. What's the frame of reference or baseline for business results? And so we're going to talk about this, and then this afternoon, Keith and I are going to get back on stage and talk about how to build a healthy or sustainable business. So we had a lot of fun preparing for this topic. It's a meaty topic that we know really well. And so we're going to start with Keith, who's going to talk about how do you know when you have a healthy business, and then I'll spend some time addressing how to assess the health of your business. You'll see us interact on stage a little bit. Keith is an expert at valuations. How do you know, what is your business worth? And in my case, I've worked with quite a few wineries, helping them take that value and take it through their business to reap the results they're looking for. We will have a Q&A, and at the end of this, we'll have plenty of time. We want to hear your questions. And what I'm going to do is just move into the topic then. First of all, who's in this room? I'd like to know who is in this audience. How many of you are selling, not producing, but selling over 5,000 cases in the market today? How many of you? So I see a few of you. There's got to be more than that. Over 5,000 cases? Okay. So I would say there's probably about 30%. And how many of you are going through some kind of transition? So that could be moving to profitability, materially trying to grow. It could be succession, trying to bring the kids in, or getting your business ready for a sale. How many of you are going through some kind of transition? A lot of you. A lot of you. And how many of you are looking to become more profitable? I'd like to see everyone's hands go up. Yay, so you're in the right room today. So if that's the case, what's driving this topic? And I would say there are a couple of things. You've recently seen the headlines about Oregon and the need for wineries to become more profitable here. And you've also seen the headlines about continuity, generational continuity. There's a generational shift going on. Rob McMillan with Silicon Valley Bank and I produced a study in 2008 about this. This is not just Oregon, this is an industry issue. And it's compounded by more competition. We're seeing, the headlines in Wine Business Monthly last week talked about how there are over 9,000 domestic wineries competing for less than 10% of the US market. And there are 30 other wineries that have the 90% of the market. So huge competition, consolidation at retail and wholesale. And this is making it very challenging for business owners who are 5 or 10 years away from retirement and are looking to sell or exit. So is Eric McLaughlin in the room? Are you there, dude? Okay, well, I will ask him the question this afternoon. He's going to be in our panel this afternoon. We all know that building a more profitable winery does not happen very easily. In fact, it doesn't happen overnight. It takes a lot of focus and discipline. The wine business is just a complex business. It's not easy for anyone to sort out. But the good news is there are many folks who are trying to do this. I recently polled 40 winery CEOs as we just launched a Next Generation CEO Roundtable here. And this is what is keeping them up at night. They're obviously concerned about cash flow and profitability. They're concerned about, are they spending enough or too little? They're concerned about their goals. Do they have the right goals in place? And they're concerned about people. Do they have the right people? But most importantly, they're asking, how do I know if I'm healthy? How do I know if my business is healthy? So what I would say is when a winery owner asks me how his business or her business stacks up, I would ask back, well, what's your goal? What does success look like? And sometimes I get a blank stare. But what I can tell you is, not unlike that blood test, it's hard to measure the health of your business without a set of goals, without knowing where you're headed, without a baseline. And so for a winery, it's usually a future vision or a set of goals that are high level, like profitability or valuation. And it's also, who do you want to sell to? Because no matter how you look at it, you're going to sell to someone someday. It may be employees, it may be the kids, it may be a third party. That or else, you're going to, if it's a hobby, then you're going to be turning that off as you move on to something else. So I want to break this down a little more succinctly. If your goal or vision is to become a leading producer of Oregon Pinot and Chardonnay with sustained profits through multiple generations, then I would say, what does this look like from a business model standpoint, a financial construct? What will it take to make this work from a revenue and cost structure? What will it make to drive a sustainable business and drive the right kind of valuation? What will it take to sustain it? And then I would also say along the way, how do I know if I'm focusing on the right issues at the right time to build that specific business into that specific model that I'm targeting? How do I measure my progress along the way? So what I'm going to do is hand this over to Keith to start his presentation. He has some comments and some recommendations on how to think about some of this.
Thanks, Deb. For those of you who haven't met me, I'm the guy that you normally call in to do the valuation of your winery operation. I'm not the guy that does the valuation of the dirt, the vineyards, the buildings, but the operation of the winery itself. So I'd like to give you a little bit of an idea of what I see of your business when I come in and take a look at it, because I think it could be helpful in when you make decisions on what you're going to do in the next step on your winery. And of course, it's always danger to look what's going on inside Keith's head all the time, but I do want to give you some grounding on that. So I want to start where everything in my mind goes. Value starts with cash flow, and I put it in big red letters so everyone can see it and understand it. Everything as far as value starts with cash flow and ends with cash flow. Now, I'll start right from the beginning. When I say cash flow, I mean positive cash flow, not negative cash flow. We as human beings have a pretty good understanding of how to spend money. But I'd like for us to spend a little bit of time on figuring out how to make more money on our business. So, and why is cash flow important? So, these are all things you know and understand, but I want to just kind of go through them again. With cash flow, you can fund business expansion, which would include for you inventory, because inventory is such a big item on your balance sheet. It pretty much controls everything. You can pay down debt. You can buy out stakeholders, especially those pesky stakeholders that you brought in at the early part of your business, that now you'd really like to be able to buy them out. If you have cash flow, it gives you the option to do that. You can distribute to stakeholders something more than what your tax burden is. Wouldn't it be nice to have something at the end of the year that you can distribute out to you in excess of the cash that you need in order to pay Uncle Sam? You can fund growth for family members in the business. You can, if you have cash flow, then you can push your business down to the next generation if you choose to do that. But knowing that most of the time the younger generation does not have the funds available, doesn't have the capital available to purchase the business, the cash flow needs to come from the business. So if you have it, then that option is on the table. So I want to spend a few minutes on this slide, and I'm going to pull it up here, put everything on it. I'll start with this, and sit back, because I'm going to spend a few minutes on this slide here. You can utilize this really simple tool. People call me in and say, Keith, what you do is complicated, and I want you to help me with it. I hate to blow your minds, but what I do is pretty darn simple most of the time. And all the decisions that I make can almost be encapsulated on this very simple formula right here. The value of your company is its cash flow divided by risk minus growth. Now, we can spin this a lot of different ways, but this is really what it is. So, let's say for an example, I've got a company. My winery generates $100,000 of cash flow every year. And I have a 20% risk and a 5% growth, long-term growth rate. When I mean growth here, this is long-term sustained growth out into the future. Well, 100,000 divided by 20% less 5%, or 15%, is $750,000. That's the formula, and that's how it works. We can make it more complicated, can't really make it less complicated than that, but that is the process that it goes through. And one of the first takeaways I want to give you today is this formula is a great formula for you to use when you're trying to make decisions on how to spend my hard-earned capital in my business. You can start with, okay, should I spend $10,000 on this item or $20,000 on that item? You can just say, okay, does it, number one, increase the cash flow right now in my business? Number two, does it create additional growth for me in the future? Or number three, does it reduce the risk that I have as a business owner? If it does not do one of those three things, then you probably should consider not taking on that purchase. So when you come to me and say, Keith, I've got this great idea, I'm going to spend $20,000 on a new chandelier for the tasting room. The blank stare I'm giving you at that point in time is me trying to figure out which box this checks in that. And if it doesn't check one of those boxes, then I think you need to go back to the well and figure out if that is the best use of my capital. So, in summary, when you increase cash flow, you elevate the return on your investment and in your business. And before I move on to the next slide, very quickly, when I'm talking about risk here, when people ask me, what do you do? And I say, most of the time, I'm spending my time trying to assess the risk in a business. That's probably where most of the work that I do goes into, is just trying to figure out that number. Risk consists of two things. What we're talking here is investment risk, number one, because I'm talking about the financial value of your operating business when we're talking about all of these concepts here. So risk is number one. The capital structure of your business. You put money into your business. Sometimes you borrow money, you leverage your business, and the bank puts some money into your business. That's one aspect of risk. The other aspect of risk is how you normally consider the term risk. Risk is something that you have to balance between an award. In other words, a riskier business is one that's more dangerous than another business. And as all of you know, there's a certain amount of risk in what you do. Every time that you're trying to figure out somewhere around the 1st of September how much longer to let that fruit hang on the vines, that's a lot of risk that's hanging out there. And some of that risk cannot be mitigated, not easily mitigated. But there are some things that can. You can mitigate risk by maybe spending a little bit more time on getting those grape contracts just a little bit more secure, or spending a little bit more time on making sure that your key employees are well taken care of and you have non-competes or other structures available in there. You can reduce risk by making sure that the labels that you have and the brands that you have are legally secured. Those are ways that you can reduce risk, and by doing that, even though you spend some money on it, you are increasing the value of your company. Because let's say if we say the same $100,000 cash flow on a business, and now the risk is 15% minus a 5% growth rate, then all of a sudden the value of my winery has gone from $750,000 to $1 million. It's just the way the numbers work. So I'm going to spend the next few slides, I'm going to go through them very quickly. I just want to make sure that everyone understands the terminology that we're talking about here. So first off, what is cash flow? And we're going to start with pretty much at the bottom of your profit and loss statement, your income statement that you get. You start with net operating profit after tax. And why do we say after tax? I'm assuming, I really can't see out there, but I'm assuming that most of you, your businesses are in a flow-through entity. You're in an S corporation or an LLC where you get a K1 as an owner, and then you pay taxes at the individual rate. So you're not going to see a line for income taxes on your profit and loss statement. But me as a valuator and anyone coming in as a financial investor in your company or a financial buyer of your company is always going to be looking at things after tax. So you need to consider that when you're going through the process. We're going to add back depreciation and amortization that's up high on your income statement. We're going to also either increase or decrease if you increase inventory, that's a reduction of cash flow. If you decrease your inventory, then that's an increase in your cash flow. So whatever the change in your inventory between the beginning of that period and the end, we need to throw that in there. We'll subtract for any assets we bought. And occasionally you sell some assets, so you add that back in. And finally, to the extent that you paid down debt or borrowed money, you'll make an adjustment for that as well. In the end, you're going to get to your cash flow number. So what's net operating profit after tax? Well, the net operating profit is basically just your income statement. You've got revenues, you've got direct expenses, cost of goods sold, and then after direct and indirect expenses, you're going to have your earnings before interest and taxes. You'll pull your taxes out, and you're going to get your net operating profit after tax. Cost of goods sold, and this is going to be a plug for all the accounting firms that do this type of work. Cost of goods sold in your industry is difficult. And you need to make sure that you've got people both in-house and your advisors that know what they're doing when it comes to this, because there's just no way around it. It's difficult. Now, cost of goods sold consists of grapes or bulk wine. If you're an estate vineyard, then you're going to have farming costs, depreciation, and improvements in there. Sometimes you purchase fruit, sometimes you sell it. Occasionally you do some bulk wine purchases. You'll have bottling expenses, warehousing, cooperage, storage. And then you're going to allocate a certain portion of your overhead to the cost of goods sold as well.
So I have a question for you.
Yes.
Why is COGS so important?
Well, a couple of reasons. Number one, there's the concept of matching your revenues to your expenses. And since we're talking about a company or an industry where inventory is such a big item, cost of goods sold, and the matching of those costs with the revenue. And sometimes those costs are actually expensed. As a matter of fact, most of the time those costs are expensed in years before you sell the wine. Cost of goods sold being tracked properly is the only effective way that you can really understand what your true costs are. So capital employed, this is your balance sheet, basically, of your company. We're going to start with net working capital, cash, receivables, your wine inventory. Now, technically, inventory is a part of working capital, but since this is such a big item on your balance sheet, I always consider it separately. We have the net winery assets, equipment, and other fixed assets that you need to operate your winery. You'll borrow some money, and then the sort of whatever's left over, that's your capital employed. That's the money that you have in your business at that point in time. So what I've done, the rest of my presentation, I've created a dummy 5,000 case winery that we'll go through. And I don't have the balance sheet for the winery on any of the slides, so I'm just going to tell you right now what's in it. I'm assuming you're going to have $100,000 of net working capital between receivables, cash, and payables. I'm going to assume that you hold your inventory on average 18 months. You're turning it every 18 months, and that creates basically $750,000 of actual costs that you've incurred and have an inventory at any point in time. Your net winery assets are $500,000, and I'm assuming that you're able to borrow $500,000. In other words, you're able to leverage all of your winery assets in there. So your capital employed in a situation like this then is $100,000 plus $750,000 plus $500,000 less $500,000. So capital employed $850,000 in your 5,000 case winery. So finally, what's return on investment? Net operating profit after tax divided by your capital employed. So, question for the audience. If I know my capital employed is $850,000 and I want a 10% return on my investment, what's my net operating profit have to be? This is the audience participation part. $85,000, right? $85,000 is my net if I want a 10% profit. And I've got $850,000 employed. It's that simple. So, here's my base case. Give you a second to kind of go through this slide. I have a 5,000 case producer that sells everything he produces every year. 5,000 cases. Sales cost is 25% of revenues. Overhead, $200,000. Owner's compensation, 50 grand. Now, a lot of you don't put owner's comp in there. You need to put something in there. You guys work hard to the extent that you're not taking compensation and it's not including in the metrics that you're looking at. You need to do that. Now, I understand for most of you, $50,000 is really mean you're making 10 bucks an hour, right? Because you're probably putting 5,000 hours into your winery in a year. But you need to put it in there for two reasons. Number one, you got to bring money home in order to keep the lights on and food on the table. And number two, any financial investor is going to account for what efforts you put into the winery because they are going to have to replace it if you're not there. And they're not going to do it most of the time. Now, what's not on the list here is that we're also assuming that you're going to buy your grapes and you'll get 60 cases a ton for the grapes. See what else here, hold on. And not counting, the other cost of goods sold is $60 a case, not counting the fruit. Here you can see our product mix. We've got basically 3 different labels of varietals, the way you want to call them. I needed to keep it relatively simple here. Your cost per ton at $3,500 per ton, $2,800 per ton, and $1,800 per ton. And the ratio is 20-40-40. So I did the standard 100 metrics. So $35 bottle of wine, a $28 retail bottle of wine, and $18 retail bottle of wine. And your channel allocation is 40-60 direct to consumer and distribution. The results is that this is a break-even winery. Average revenues, basically $200 a case. Gross margin right at 50%, so half of the revenue was spent on cost of goods sold. Your break-even, well, your operating margin's 0. Doesn't take a brain surgeon to realize that, okay, if my operating margin is 0, then return on my investment is also 0. Actually, as you can see at the bottom of the slide, it's slightly negative. Break even is 5,000 cases, so you're just, at this point, you're treading water. And I see way too many of these kind of wineries in the work that I do. And I can tell you at this point, a winery like this is not sellable as an operation. It's sellable as a collection of assets. But as an operating winery, there's no value there for a financial buyer to come in and utilize. So we need to create more value. So let's talk a little bit about what we have. I'm not going to talk at all about, well, we can squeeze overhead or maybe our sales cost can be 20% instead of 25%. I don't want to go there. I want to go to some of the things that we've been, I want to talk about some other aspects of it. First off, we see that in this situation, even with this break-even winery, they're selling everything they produce. And I know this is hard to do all the time because sometimes you have a big harvest, sometimes you don't. You have great wine. Sometimes you have some wine in inventory that's harder to sell. But as a rule, you should, unless you're looking to grow and it's in your plan to grow, you need to do your best to sell everything you make and don't make any more than that. We're going to talk about the product mix. Here we've got 20, 40, and 40. And how changes in that can affect your bottom line. The retail price, as Christian and Rob just said to you, there's probably some limitations on your ability to just say, we're just going to increase the value of our $35 wine to $40. Possible, but it might be difficult for you to do that. So I'm not going to concentrate on that this morning. But we will talk about channel allocation and how that can affect value. So, yep, I did all those. So here's the first scenario. Let's increase direct-to-consumer. If you recall, we were 40% direct-to-consumer. What if we just went 50%? We moved 500 cases from distribution up to direct-to-consumer. What would the result be? Our average case sales price went from $203 to $217 a case. Our gross margin went from 50% to 53%, and our operating margin went from 0 to 5%. We dropped $500,000 to the bottom line. Our return on our equity, or return on investment, our ROI, went from a negative number to a positive 6%. Not a bad first start. Okay, let's take a look at number 2. Let's change the product mix, and let's increase the volume at the mid-range. In other words, let's take 1,000 cases that we were currently using to produce the $18 bottle of wine and move it up to $28. That's all we did. Our change here is that our average case price went from $203 to $219, operating margin of 4%, and we dropped $40,000 to the bottom line that wasn't there before by making that change. Our return on equity went from negative to a positive 5%. Another good start.
So Keith, what's a good return on equity?
I would say and we're using the term sustainable here loosely, but for a sustainable business, you need to have at least a 10% return on your investment. At least. If you're going to hire me to come in and value your winery, if you don't have at least a 10% return on your investment, then I can pretty much guarantee the value of your winery is the value of the tangible assets that you have on your balance sheet. And I say tangible because I'm going to have a hard time financially being able to come up with an intangible value for your brand. People keep asking me, what's the value of my brand? You have to have cash flow to have a value in your brand. That's just the way it works. So, 10%, at least. 15 is probably the real number. 15% is probably where you'll actually start creating intangible value for a 5,000 case winery. So, what if we just put both together? We increase direct-to-consumer to 50%, and we increase we took out of 18 to $28. What we end up now is our average revenue per case went to $234 a bottle, up from $203. And we have an operating margin of 9%. Not quite 10%. 10% I think is probably another one of those low-end bogeys. You need to have your operating margin at least 10%, but we're close here. And what you had before, you had an operating profit of 0, and now you have an operating profit of $100,000. So you can see once you went back to that formula where it was cash flow divided by risk minus growth, that, well, if I have $100,000 on my 5,000 case winery, I might be getting to the point where I might have some intangible value. My brand might have some value over and above it once we get close to this. Our return on equity is 11% here. So This is a good starting point. And before I hand it back over to Deb, I wanted to go back to one issue here.
Thank you.
Is you should have these numbers in your hip pocket, just in order for you to be able to make good decisions. For all of your labels or SKUs or whatever you want to call them, you need to know what my gross profit is, both at retail and at distribution. For my $35 wine, my gross profit's $25 if I sell it out of the tasting room, but it's only $8 if I distribute it out. Just the way the numbers work. And here's the hard thing to hear. My $18 bottle of wine, I can sell it and make $11 out of the tasting room, but I'm only getting $1.50 if I distribute it out. That might be a little low because there's no cooperage in there and stuff. So let's say it's $2 or even $2.50. My question would be, does it make sense for you to distribute out $18 wine that you're only getting $2 of profit on for all the risk that you're taking, and understanding that the capacity of your winery is only 5,000 cases? That is an important, valuable asset that you have. And would it be better for you to consider over time moving some of this lower tiered wine that you're distributing out, either move it up to $28 or maybe don't, in other words, move production out of that area and only sell your $18 wine direct to consumer, or as little of it as possible, because that's where you're going to see the best result on your bottom line. That's where cash flow is going to come from. Yes, you can increase capacity, but I would even say, why increase capacity to get $2 a bottle through distribution? I don't think that's a good use of your resources, those very valuable resources that you have.
So I have one more question for you then, believe it or not. If you're looking at gross profits at a product level, which is what you started doing there, is there a bare minimum when you're looking at gross profits as a percent of sales that would be a target for any of these wineries in the room?
Well, Deb, I haven't thought about that much, but I know that you're going to talk about it here in a few minutes, so I'm going to wait to hear what you have to say about it.
Oh, cop out.
Okay, it is. Here's a recap very quickly. We went from our base case of break even, where we have a negative $1,500 of operating profit, and we can maximize it, at least in this scenario, at $100,000. We've done this. We basically moved $100,000 to the bottom line, but if you take a look at our revenues, they went from $1,013,000 to $1,171,000, only less than $160,000 difference in top line revenue. So $100,000 of that $160,000 made it all the way to the bottom line by adjusting these two items. So, and your operating margin went from 0 to 9%. So you're able, without incurring any additional capital, without going to the bank and borrowing any more money, or going to your investors and asking for any more money, getting more out of your bottom line just by being smarter and more strategic in how you're selling the very good wine that you're making. I didn't follow. So this is just wrapping up here. Is this your slide or mine?
That's yours.
Okay,
That's
all
your
right.
final
Making
slide.
sure I'm not final slide. So, as I said, address those varietals that maybe that aren't performing as anticipated. Keep your volume and sales forecasts current. Make sure you understand how your cash flow and when it cash flows. Keep on top of your scenarios. I update them, I would say, quarterly. Monthly might be a little too aggressive, but definitely quarterly. And do a realistic cash flow. I would even say do a sort of, if the wheels fall off cash flow, if I hit it out of the park cash flow, and then sort of your best guess of what you anticipate happening over the next year. And make sure you always have some dry powder in there somewhere. Have a plan B, whether it's I've got a line of credit I haven't drawn on, or I have some investor that I can always go to if I need just a bit more capital when I wasn't really anticipating that I needed it. And review your capital spending plans. So with that, I will turn it over to you.
Well, not bad for a guy who just got off a plane from Mexico for a week. And I'm going to give these back to you.
Oh, yeah.
Okay,
I'll take these.
so here we are. How to assess the health. So we're going to talk about some tools that will help you get at your temperature. We did say earlier that it's important to stop from time to time to assess the health of your businesses, and especially essential when you're engaging in strategic planning or looking at improving business performance on a key operating step, such as expansion of tasting room or a new product launch, or considering taking on additional debt for other purposes. So when I get a call from a client, it frequently falls into one of three buckets. Complexity and confusion. Usually the question is decision-making has become more complicated, where firefighting constantly is consuming everyone's attention. We're able to only operate in the now, not in the future, and think about the future. Another bucket is what do I call financial misses, and this would be I'm unable to get cash flow under control. I've had surprises. I've had too many financial surprises in the last year, or my quarterly projections have been missed frequently. My cost of goods are escalating. I don't really have control over the costs behind my cost of goods, or I don't know what products are profitable. And then the final bucket is something called slow like mud. It's typically about a key employee. So some of my employees, members of my team, are not keeping up. They appear a little bit weaker, or maybe it's me, or my growth has really slowed. And so the question is, what can I do in these situations? Well, my answer usually is, let's start with a diagnostic. Let's find out what's going on in your business right now. What are the issues? And so we're going to talk about some decision-making tools. But first of all, performance management is a concept. We all read about this, and some of us actually manage their businesses according to this. But what is this? It's really a set of management and analytic tools, processes, and certainly it helps you with defining goals, but more importantly, it helps you measure and manage performance against these. So what does this mean? Well, there are many ways to measure performance. There are many ways to take your temperature. We're going to briefly talk about 5, and more importantly, just the top 3. So pure benchmarking is one approach to taking the temperature. Another is what we call operating gap analysis, or operating gap assessments. And then scenario planning. I don't know if that shows up in the blue up there. We do a lot of market opportunity assessment, so assessing your markets. And in this case, Christian Miller, for example, is someone we bring into a lot of our client work to understand better how their brands are performing or where they should be pointing next. And then, of course, Keith is heavily involved around business valuation. So we're going to take the top 3, and we're going to dissect these a little bit. What do these mean to you? So pure benchmarking analysis. What this is what organizations increasingly depend on financial benchmarking and analytics to drive important decisions and remain competitive. What this tool does is it informs key decisions around profitability and cash flow, which Keith just spent a lot of time on, and it gives you a much clearer idea of the picture of your business, both from a where your strengths are as well as from where your weaknesses are, where you may want to apply more resources or attention. It's understanding whether or not and how much you're spending and is it appropriate on your sales and marketing or administrative side of the business as much as on your product side. It also shows you how you're doing vis-a-vis others on your sales performance and your different channels. It helps answer the question of how do you stack up against your peers, your region, another region, best practitioners, and of course, the downside of this is if everyone's doing crappy in your region or in your peer set, is this a good baseline? And what I would say is that category leaders typically stack up much better than the norm, and they'd manage to do that year after year. So we need to understand how category leaders operate and why they can do this. But by benchmarking your winery, you are able to leverage then best practices in a very meticulous way, and you can set the foundation that enables your organization to make good decisions and more strategic decisions and engage in initiatives that help grow your business in a profitable way. Now, do you do this every month, every year? Not necessarily, but I certainly recommend on an annual basis if you're looking at a strategic plan and reevaluating where you're headed next, or at least when you're facing a key decision that falls outside of your operating plan or outside of your strategic plan. Typically go outside, you're looking for people or organizations that have deep databases. So banks, for example, Silicon Valley Bank does an extraordinary job with peer benchmarking. CPA firms, and certainly at Sign Advisors, we do a lot of this kind of work as well. So let's give an example. Well, benchmarks usually have more metrics associated with them than what you're seeing up here, but I'm using the example that Keith just walked you through because it's simple to understand. And the key thing around benchmarking is that you're looking for a peer group, whether it's within a region or within a broader region that is similar to your business. So in this case, the 5,000 case winery is Pinot and Chardonnay. We're pretty much operating within that $200 to $300 per case revenues. And you're also looking ideally at a peer group level to identify some folks that are hitting kind of the same phase of growth that you're operating within. So what you then do, if you take your base case and you look across to your peer group, and your region may be Willamette Valley, and the other region, let's say it's Sonoma, you start looking at key metrics and you compare them. So if you look at the channel and product mix, you see it shifts from one group to another. You also look at your average revenues per case, and so you'll see how that changes from one peer group to another. And obviously that impacts your cash flows dramatically in this case. Wouldn't it be nice to be in Sonoma on this one? And your gross margins as a percent of sales is another important number to watch and see how that changes. So where are the opportunities to improve things? Well, we're going to assume that you are already doing what you can on the operating expense side. So there are really only three other levers. There's price, there's product mix, and channel mix. If you're going to look at this more strategically, and according to Keith's exercise, there is value in that. So I'm going to ask Keith another question, see if he gets out of this one. From your standpoint, what kind of average revenues per case do I really need for a winery of this size to be profitable?
Well, as we've seen on there, the 234 was just the minimum. I would say, I would think a goal, the minimum goal I would say would be 240, 250 I think would be a good bogey to shoot for begin with. And obviously if you can get more than that, then great. But I think you've got a healthy winery if you're in the 240 to 250 range, everything else being equal.
So there are rules of thumb out there, and obviously in different regions you have different cost structures and different brand equities as a region and the players in those regions. But Constellation, a large wine company, about 10 years ago did a study at different price points to see roughly what kind of gross margin targets you would need to achieve to be sustainable and be healthy long term. And so if you look at, for example, $25 to $50 segment, they came back with 60 to 65%. If you look at, for example, SG&A, marketing, sales, and administrative expenses, the target there would be 30 to 35% as sales. Now, depending on your phase of growth, you may be at the lower end or higher end of that. And then operating profit targets, again in the $25 to $50 segment, 35%. Now, the caveat here is this may feel really aspirational to most of you in this room. In fact, you might say to me, this doesn't even look like my business. However, I would say that it's necessary for you to consider these goals if you're going to have enough income off your winery and off your business to actually reinvest in growing the business, especially in a business that is pretty dominated by assets like wine production facility or vineyards. And if you want to have a sustainable business, you'll need to figure out how to actually build towards these metrics. Otherwise, you'll be working really hard, as Keith said earlier, to build a business that has limited or no returns. And we want something different for you. So let's step into operational gap assessments, operational gap analysis as a second tool for evaluating the health of your business. In this case, you're looking at measuring your people and operational practices and processes as opposed to the financial benchmarking that we looked at earlier. And we're looking at this relative to a peer group or leading practitioners. And from this assessment, you end up with a set of recommendations that are practical on what you should do to increase productivity, effectiveness, or competitiveness of your business. For example, do I need to hire an accounting manager? Or do I need to spend more money on FOB depletion reporting? Or do I need more formal meeting time with my team to focus on profitability and sales results? And so you can see these are practices and processes that matter to your business. The frequency of this is it depends. If you're doing a deep dive that is more of an annual, every 2 years, where you may be going through a new transition, as many of you are, or a new growth cycle where the snapshot of your business will be dramatically different, then I would say, do this once every 2 years or so. On the other hand, there's a quarterly approach to things where you're actually doing performance management internally that's being reviewed by your team internally on a quarterly basis against a set of goals and metrics that you've established, focused on the plans that you have, hopefully. And so there's really two approaches. So frequency is ongoing. You want to constantly scrutinize your business to see where you can improve, where you can increase productivity. And if it's the annual, or every 2-year big assessment, then a third party is necessary who has a purview and an understanding of how other businesses like yours are performing. If it's the internal, obviously it's your team, and having someone lead that activity on a monthly, quarterly, annual basis is important. Frequently it's your CFO or an owner if they have that experience. So what this looks like is as follows. In the in-depth operations assessment, you're looking at perhaps 10 different business disciplines. You're looking at strategic planning. Do I have one? And if I have one, then have I communicated that? Are all my stakeholders, my customers, and my team engaged and aligned with this? Operations planning, how am I doing there? Financial planning, accounting practices, production, marketing and sales practices, my brand practices, am I doing brand management? What does that look like for my category or for the size of my business? And all the organization leadership, succession, as well as governance. And so scrutinizing your business in this level of detail can really help you uncover opportunity to increase your performance. Now, this is an eye chart, but this would be the flip side of things. This would be the internal review and performance management that you may be doing monthly or quarterly or annually. And so what you see here is a set of goals that are observable or measurable that are lined up against each function of your business, and within those functions, a set of goals that you're trying to track. So for example, have you achieved your goal of a certain average revenues per case, or a certain number of cases being sold, or a certain criteria for consumers that are coming in your tasting room? Are you tracking against your tasting room goals? So the third tool that I mentioned was scenario planning. And what this is really all about testing out ideas or concepts before you actually move to action and spend money or get the team rallied. And it's so easy in day-to-day to get caught up in making decisions and just moving forward, but stopping for a few minutes can have a huge difference on your business. Net outcomes can include a better understanding of the impact of a new product launch on your contribution margins, or it can have getting more proactive about what your options are for increasing valuation or shareholder equity or the equity surrounding your owners. It can be about evaluating how to reduce or eliminate costs that are based on product strategy or organizational design or outsourcing concepts. Or it can be about pricing, helping your organization make more considered decisions around pricing relative to products based on market conditions or based on your product and channel mix that Keith referred to, or understanding your product costing. So the reason for doing this is you want to understand the impact on profitability of any decisions that you make that are important decisions and how profits could flow through your business through possible future scenarios. You know what's going on in the past, what could be the possibilities of what ifs going forward. And again, this is something you may do annually if you have a strategic planning activity, or certainly when you might want to make a key decision that is outside your normal operating budget. So let's play with this a little bit. And what I want to do here is take, again, Keith's example, where he took a base case and he added in a couple strategies to drive increased net operating margins and cash flows. So on the right there is the both scenario. And what I want to do is take a snapshot from the base scenario of a product portfolio associated with it. So in this case, we have 2 Pinots, a Chardonnay, a Pinot Gris, and a Viognier. And to make it easy, I've assigned 1,000 cases to each for a 5,000 case total. Pricing ranges from $18 in the Pinot and Viognier, Pinot Gris rather, and then up to $35 in the estate tier Pinot Noir. Now, to the right side of this, you'll see something called gross profits as a percent of sales. And this is where I asked Keith the question earlier. What is a good gross profit for you, for this size business in Oregon? And when you run the numbers and you understand the importance of reinvesting in your business, we usually look for at least 50% gross profits as a percent of sales at a product level. So if you're achieving that at a product level, then you have the chance of building a business that is sustainable and repeatable and scalable. So if we look at these 5 products, what do we see? Is the audience awake with me? Anyone know? What do you see with the 5 products? Well, we see that 4 out of 5 are not as profitable as you like them to be. We see 47% and 42% as a percent of margins on your second tier Pinot and your Chardonnay. And we see really bad margins on the Pinot Gris and Viognier that are, you'll see shortly, are mostly in the FOB market. So 4 out of 5 are underneath that 50% contribution margin threshold. What are our options? Well, we can decrease costs across the company. We can also look at reducing assets at a varietal level. An example of that would be to manage inventories differently. And then where I'm going to focus briefly for the purpose of this scenario is increasing pricing or changing channels and moving product to a different channel to get better gross margins. So what do we have here? So at the bottom of this table is the product portfolio that we've been talking to. And so you'll see that, first of all, we've moved the second tier of Pinot from $28 to a $31. So we've changed price here to get at 50% margin. Now, there are a lot of things to consider here. Will you be cannibalizing, for example, your estate tier by moving it so close in price? Is the product tier and the lower tier quality good enough that you could actually move it all into an estate tier and get better margins? So these are different options to consider. In the case of the Chardonnay, I simply moved a few hundred cases from FOB into your direct-to-consumer channel, and this gave you a much better gross margin. And so I think you're getting the concept here. In the case of Pinot Gris and Viognier, it's a much more difficult challenge. In FOB, you just cannot make enough money out of this, so for this size winery at least. And so you either shift those cases to direct to consumer, and you get a nice margin, 65%. Or maybe you get out of this, or you reduce your dependence on this if you still want to keep it in FOB, and there's a reason to do that. Just as important as assessing what to do with these products to drive profitability and position is looking at how many cases are now going through direct to consumer. And of course, you'll need to assess how realistic it is to do that. But I would say probably the right answer is I need to do that, because at 5,000 cases as a winery, I should be mostly direct to consumer so I can drive his profits through it, maybe with some of my wonderful wine sprinkled out strategically among certain accounts in certain regions, but most of it DTC. And if so, what do you need to do to achieve that position? Okay, so what now? Well, right now we can certainly fill the gaps from all the work we just did. But fundamentally, if you take the right steps to invest in key resources at the right time or right business cycle in your business and get ahead of the issues before they happen, you'll be in a much better position. And what I've observed is that successful business owners who adopt these kinds of practices, unlike those who chalk up failure to poor market conditions or adverse sales environments, really reap the results. And so, in conclusion, these tools can help you become more proactive and less reactive to business cycles or market conditions. So this is one of our favorite slides, but I guess what I always ask myself is, why am I so concerned about a healthy business? Well, first of all, that's what excites me, but what we see is that by building strong business and a strong team, our clients and our industry players end up with stronger options later and avoid the need for a fire sale, because believe me, I get those calls as well. And whether the eventual sale is intended or unexpected, you'll be ahead of a lot of folks if you're able to actually put in place the best practices and adhere to them. The adhere part is essential as well. The discipline of, now you've got these tools and making sure you have the quarterly, annual meetings and you're actually applying the results, what you've learned from these tools. So our best advice is to take control and start early and enjoy the journey. It does take 5 or 10 years, as many of you know, to build a strong and sustainable business foundation. And almost anyone, I would say today, can become a decent winemaker. They're showing up all over the place. But I would challenge you to focus on becoming great at building a profitable winery. I'd like to see a lot more of those out there. And I thank you. So we have about 10 minutes.
We have about 10 minutes, so
10 minutes
we'll
for
open it up
questions.
to questions. I cannot see it all out there, so...
Maybe we can turn the lights up a little bit, not these lights.
So if anyone has questions, either for Deb or myself, we'd
There's a
love to entertain them.
microphone, so if you stand up so we can find you, thank you for turning the lights on. There's a microphone that can be passed to you. So if you stand up or put your arm up, here's a young lady over here.
Hi there. I'm a student at Shemeketa's wine business program, and I'm kind of studying a little bit about the feasibility aspects of wineries, as well as I'm representing a small winery that's developing as well. And one of my questions is, realistically, how many wineries do you actually see move 100% of their winery every year? Because I've worked for a couple different places and visited a lot of wineries trying to taste and learn about their brands, and I've never personally seen too many, I guess I've never heard of or seen too many brands move 100% of their inventory each year. I don't know if that's a realistic number or...
Well, I'll start with that, then you can finish. 100% no, but let's say 95 to 99% yes, assuming that you've got 5% for your tasting room samples and shrinkage and spoilage and library building, things like that. But I've seen a lot of wineries in my work where on average they sell 100% of their winery. That doesn't mean that occasionally they've got some wine from a vintage that for whatever reason they have it in inventory that they would really like for it not to be in inventory. But as a plan, I've seen enough wineries that pretty much produce everything that they sell. And my question would be, well, if you're not selling all of it, then why are you producing it?
Yeah. And I would reflect the same thing. It's pretty much the difference between a winery that's operating at a profitable level and a winery that isn't, or less so. It also has to do with growth phase. You may be in a big growth phase, and you may have plans to be selling most of your wine within a 12 to 18 month period, but you may be off. And so I would say in that case, you need to go back and reevaluate your assumptions and the resources you put against those assumptions. But the goal for, I think, anyone who's looking to have a profitable, non-hobby winery is to sell through.
Yeah,
Thank you.
sure.
Any more questions?
Well,
Silence.
I do have one
We
question.
are sitting here before
There's
lunch,
a
I know
question
that.
over here.
Okay.
Yeah, I have a question.
No.
Oh, one over there?
Yes, thank you. Very informative presentations. I often see wineries with similar financial performance, but wildly different staffing levels. Do you find that a lot? And they think, well, we're doing about as good as our competitor down the road, and you realize they have 2 or 3 times more people.
So to clarify your question, would these be wineries of same size and same phase of growth, or different types?
Yes, similar.
Similar, okay. Well, I would say, yes, I've seen wineries that have 3 winemakers at 10,000 cases. I've seen wineries with 1 winemaker. I've seen wineries that don't have a head of marketing and don't really focus on marketing. It's more of a sales direction, so they staff up on the sales side. In a 5,000 case situation, it's less frequent to see a lot of variability around staffing because you're limited in terms of number of people in the business.
Right, you're going to have to, assuming those people are not doing it for free.
Yeah.
I mean, there's a cost to staffing up more, and I'm sure you're aware of it probably more than me. It's expensive to have people in there.
I think the more important question is less about looking at your neighbor to see what your neighbor's doing, but really think about what are you trying to accomplish, where are you headed next. And then this afternoon during our next presentation, which is about how to build a sustainable business, we'll be talking about staffing and what to consider at different phases. We'll be going beyond the 5,000 case and going into 10 to 20,000 cases as well.
Yeah, and we'll talk a little bit about the cost implications, especially from a cash flow standpoint, of what the implications are growing from 5 to 6, from 5 to 10,000 cases.
Oregon's at an interesting point in your growth as a region right now, in that you're hitting an inflection point where your brand is being really well established. Your product quality out there is superb. Listening to Christian Miller and Rob McMillan this morning, seeing their numbers supports that. I think the next phase for this industry here locally is to think about staff and finding folks with good experience, the best experience you can afford to hire, so that they can move the needle on your performance. And this is a big challenge because you have to develop those resources. I remember going through that when I was working in Sonoma a few years ago. Sonoma was faced with the same challenge. Other questions?
Yes, there's one over here. Another question for you. I know that for tasting rooms in general that have merchandise, the margins tend to be much higher than wine for the non-wine merchandise. Do you take a look at those issues? I know some wineries say, well, we're a winery. If you want that stuff, you can go down to Macy's or whatever. And then other wineries tend to have a big merchandise program with higher margins.
Do you want to start?
We haven't talked about this at all. There are wineries that have, yes, a lot of retail above and beyond the wines that they sell in their tasting room, and also a relatively large hospitality aspect to it. And those are things that can, I would say, enhance the profitability of your business. My biggest concern, just as I guess as a consultant in that area, is it's great to do that, but don't take your eye off the ball. I mean, if you're a winery, then that's where you should be concentrating most of your efforts.
So, and I would step on that and agree with that and take it another step. What does your brand stand for? The wineries I've worked with, for example, Chateau Montelena, years ago, would not allow any merchandise in their tasting room because it distracted from their brand. They were all about wine and the wine experience. So think about, if you're going to do merchandising, it's more about brand and less about profits. And then align your choices and your strategy there with where you want that customer experience to go. To take on merchandise because you make more money on it, I would then ask the question, what business are you in? So it's back to what Keith suggested. You only have so many microseconds or minutes with your consumer. Do you want to spend that time on the merchandise or talking about your wine experience and your brand personality? More questions? I have one for Keith again. I'm good at that, aren't I? Can a cash cow, so I would say a product that is earning under 50% gross profits as a percent of sales, a cash cow with larger volumes, actually make up for lower margins?
Well, it can't make up for lower margins because it, in and of itself, is a lower margin item. So I think that a cash cow, when you're in an in-between phase, when you're growing from 5 to 10,000 cases, or maybe going from 3 to 6,000 cases, a cash cow, in order to generate short-term cash flow in the interim, is okay. But I think as a long-term strategy, I would not recommend it. Do you have any?
I'm on board with you, but it's a
Okay.
question I get a lot from my clients, and it's a concern because you have this nice franchise with a certain channel distribution. You may have 15,000 cases going into that, but your margins are 45%. And so my reaction is we need to run the numbers and see how much you need to reinvest in that and the rest of your business to actually drive the profitability you need. I've had clients who had substantial portions of their business going into national distribution at very much lower margins, where the direct-to-consumer channel was actually supporting the rest of the business because of the profits that were coming out of that. Is that a good thing? I don't know. I certainly look at health long-term, and I would say that would be a challenge.
Yeah. I would say along with that is just make sure you know exactly what your margins are on that. Mm-hmm. And if it does meet up with your long-term strategic goals for your winery, then maybe so. But normally I would say, the higher the margins, the better. You only have so much capacity, and utilize it as effectively as possible.
And don't be shy about margins. It's not a bad thing. Profits actually give you more opportunity to do what you really want to do with your life. So it's hard in a region that's emerging into profitability to think about that part sometimes. I've seen that elsewhere. We have one more minute between us and lunch. We can take one more question, if need be.
If not, we'll let you go. Deb and I will be around the rest of today anyway.
Yeah, there's one other opportunity. So for this afternoon, for those of you who are attending the next session, which is about building a sustainable wine business, and you have some questions already in your head that you'd like to ask, please write those down. There's a piece of paper on your tables, and give it to the young lady at the exit. We would love to know ahead of time what you're thinking so we can address your needs more successfully in the next session. Thank you very much.
Thank you.